Well, there's a deeply consequential shift underway in global corporate leadership, and it's one that South Africa ignores at its peril. For decades, restructuring has been treated as the corporate equivalent of emergency surgery. It's something you do when the patient is already on the table, anaesthetized, and in very critical condition. But new global research suggests that by the time most companies act, the outcome is already largely predetermined. In fact, the global CRO study for this year finds that 83% of restructuring leaders are brought in too late to meaningfully preserve value. And I think it's a stat that will feel uncomfortably familiar to anyone who's followed South Africa's recent business rescue cases. Think of Tongaat, think of the post office. By the time the intervention arrived, the conversation had already shifted from strategy to survival and from optionality to deep constraint. Today on the Monocle Banking Pod, we step into the operating theatre of the business rescue surgeons. Well, when it comes to business rescue, the South African context becomes particularly complex because while our business rescue framework is often praised for its legal sophistication, it is simultaneously undermined by a structural Achilles heel that is access to post-commencement funding. Without credible, timely and appropriately priced capital, restructuring becomes less about recovery and more about managed decline. And at the same time, globally, the role of the Chief Restructuring Officer is evolving from this last-minute firefighter to what the report calls a crisis pilot embedded in the C-suite. So today we're going to find out exactly what the shift means. And to unpack this, it's a great pleasure to be joined now by Michael Dorn, the CEO of RTgroup, a renowned business rescue practitioner, bringing both a global perspective and an on-the-ground experience in complex turnaround environments. Michael, great to have you back on. I've got to start you as we start the podcast, just with the mood in the industry at the moment. And I was watching Carte Blanche recently where the point was made that this is an industry that is so critical to preserving jobs, to keeping the economy going, and yet you have business rescue practitioners gunned down for trying to do their work. Look at the Murray case, for example, and Boa Fanikak. What is the mood like in your industry?
I think you need to differentiate a little bit, Michael, and thanks for inviting me and giving me the opportunity to talk to you. So first of all, and I hope you don't mind me saying that I'm not a business rescue practitioner, and RTgroup will not act in business rescue for a specific reason, and I'm happy to explain it a bit later. I think the problem with business rescue, unfortunately, in our country is a tool that is being used when it's always too late. So hence, because the tool is used too late, most business rescues end up in a liquidation scenario. And in a liquidation scenario, especially creditors like employees, but other important creditors lose a lot of money. And I think this is where the hostility is coming from. And then, of course, if I tie back to the study that was done, people know that if the management team had acted earlier, the business rescue would have gone in a different direction, or it could have been avoided completely. This is, for example, what I'm doing as a CRO. I'm trying to avoid business rescue for every millimeter I can for a very specific reason. Because if you go too far down the road, and if I use your example for an emergency room, if you get into the emergency room and you don't have blood anymore, then it's very difficult to stabilize the patient. And I think when you are in a situation and recognize you go earlier a little bit, then there is more opportunity on the table. And then it's also easier with a little bit more time to find the right solution. So the mood is twofold, I would say. On the one hand, the whole business rescue industry in South Africa understands that there's a structural issue because it's happening too late. And of course, all of these incidences don't make it better. But on the other hand, what I also can tell you is that there is very clearly an understanding that something earlier needs to happen, where I think the CRO comes into play.
So, I mean, if you look at that line, that distinction between being a turnaround specialist or a chief restructuring officer versus someone in business rescue, I mean, your firm does provide the whole gamut, the whole suite of services here. Where does the distinction start and end between a CRO and a business rescue practitioner?
So I would say that a CRO has more an entrepreneurial mindset, where a business rescue practitioner, given by the Business Rescue Act, has more a legalistic mindset.
Ah,
And that is two different things. Because if you imagine you have an entrepreneurial mindset, then your mindset is always, what can I do to safeguard the company? How do I get out of trouble? How do I bring the company back on track? If you have a legalistic mindset, you are, of course, more geared towards what do I have to do to meet all the boxes, to tick all the boxes I have to tick. And I understand that if I was a business rescue practitioner and I had to do all of these legal steps, then my mind would be in a different place.
I think that's a very important and good distinction, because often when you're in a bit of a pickle, take the post office, for example, if you approach that with a more entrepreneurial mindset, and I think the post office is probably a poor example because you've got all of the restrictions of the state and everything else hanging over it. But one could see opportunity in quickly pivoting to e-services and other things rather than just focused on the legal strictures of getting a BRP plan set up and all of that. But coming back to the study, it does suggest that companies restructure out of strength and not necessity. I mean, that sounds great in theory, but in practice, what does early restructuring actually look like? And how often do you see a company restructure out of strength? Surely the time that most executives realize that they've got to restructure, it's probably out of necessity.
That's a very good question. So the way I'm typically describing this is, if you want to restructure out of strength, there are two typical options that I see. I see a lot of very younger CEOs, and they basically send their company into a restructuring mindset, even if they are doing very great. And why do they do it? Because they need a tool to wake up the company and to say, we're doing great, but if we continue to perform like this, in a few years' time, we will be in trouble. So that's one option I see, but this is very forward-looking CEOs. There are not a lot of them around. The other option is you have CEOs, they understand, and CFOs, that they are like a year or 2 years away from a very difficult situation. And you will always see it, Michael, if you, for example, look at financial accounts that are being published, let's say at the JSE, for example, you see, if you are a good accountant, when a company is getting into trouble. You start, margins are not improving anymore, then certain assets are being sold. The silverware, so to say, is being sold. And when you start doing this, then is the best moment to say, wait a moment, we cannot hope that the situation is getting better. We have to act. And I think this is where a real good turnaround can happen. But of course, it's difficult because you need to differentiate between, is it just a phase where the company is struggling, or is it really a strategic issue? And I think this is where most CEOs, CFOs, and boards are struggling to see whether it's a market shift or not.
How often in the turnarounds that you've been involved in, has it been something as basic as not really paying as much attention to cash flow as one should be? And I think here, I hear stories where even in large listed companies, the CEO co-ops the CFO into doing a big M&A transaction and focusing on some of the core nuts and bolts of the business. Sometimes takes a bit of a backseat through a process like that. And then a black swan happens, say a COVID or something like that. And all of a sudden, that cash flow becomes a crunch and acute. And before you know it, all that debt on the balance sheet becomes something of an anchor dragging the business down.
Yeah, Michael, you learn it at business university, cash is king. So I can tell you all of the cases I was involved, especially if they were late stage rescues, then there was not enough focus on cash. And also, if you get more into a crisis mode, you need to look differently at cash. There's not just one cash bucket, you need to look at it by legal entity, also intercompany transfers and stuff like that. So cash is always a component of a restructuring, unless you are very, very, very early. But then you use your cash as an investment. These option one CEOs I talked about, they actually put cash aside, not for an M&A transaction, but for the restructuring of the business. It's an investment. So in my company, for example, if we do a turnaround plan, we don't call it a turnaround plan. We actually call it an investment case to demonstrate to the market we want to invest into the future, which might mean we have to cut costs and we have to margin improve and. But I think it's the connotation of we want to move forward to the future. We need financing for it. And then it's also easier for banks, for example, to give post-commencement financing.
And again, that is one of the big issues is how do we ensure that we unlock that post-commencement financing, because that becomes so critical. Let's talk about some of the early warning signals before we get to that point, because the report does highlight the obvious things: earnings deterioration, covenant pressure, maybe a loss of stakeholder confidence. What have you seen that maybe are the non-obvious signals that sophisticated investors or boards should be watching for?
I'm always saying, Michael, and I make it very simple, and I know this is, of course, a bit critical what I'm saying, but I'm typically saying it is denial in the management team. And with the management team, I mean the C-suite and the board. If you listen to, if it's, for example, a public listed company and you listen to presentations for the end result presentations, then you can hear whether a company is flourishing or not. And I always say, if a company gets into trouble, it's always C-suite. It's never the market. It's impossible. Maybe you have some things like COVID. But look, Michael, how many companies actually have flourished during COVID?
Yeah.
That is incredible. And they just had really good management team. So I think the hidden factor that nobody talks about is denial of the management team that something might not be right. And that you can only grasp if you're an experienced manager, I guess. I think if you're new into an industry or if you're a young professional, you won't even see that. And that's the reason why it's so difficult to see from the outside whether a company is in trouble or not.
Yeah, it does come down to, having an experienced board in place to be able to spot those early warning signs. And when it comes to post-commencement funding, I mean, often described as the lifeblood of business rescue. In reality, though, in South Africa, it is scarce and it's expensive, and I think it often comes too late. What is your sense? Because without capital, let's be blunt, there's no turnaround. In South Africa, is that the fundamental constraint? Is it the availability of capital, or is it the willingness to take risk?
I think it's a combination, Michael. Capital is available because if you look at our whole industry, if you look at the whole financial community, let me put it that way, there are banks. I think alone Johannesburg has 180 private equity firms, a third of them trying to invest in distressed businesses because the return profile is so high. And if you look at other, conurbations like Stellenbosch, I can tell you there is a lot of money available. The challenge is if you deploy the money, it's a high risk profile. And if unfortunately most of the rescues end up in liquidation, it's very difficult to convince investment committees to deploy the money. That's the challenge. So our challenge is that most of the turnarounds, restructuring, or if you even call it a business rescue, end up in a liquidation. So now, if you're an investment committee, why would you invest? That's the problem. I actually think it's not so much the money, it is more the outlook whether I get my money back on.
So, how would you motivate an investment committee? Because, as you said, there are many private equity funds that I've engaged with that are focused on turnaround, distressed assets, because, as you say, the returns are extremely attractive if you get it right. If you manage to find a company where you've got in early enough to triage it back to profitability. Because I think often the sense is that the banks are too risk averse or the private equity funds are too return driven. So, how would you pitch post commencement funding to an investment committee of a bank, for example?
Yes, I'm always looking at options. So if you see one of our reports, if it is about funding, we are actually quite open about what happens to a business in each scenario. So our reports would always say, here's a scenario where a white knight is coming around the corner and is giving us an equity check for whatever reason. Here's a scenario where we actually go into liquidation. Here's a scenario where we go into business rescue. And here's an alternative scenario. And these scenarios actually talk just about money. And if you can convince financiers that the scenario with post-commencement funding will come out better than any other scenario, and you can convince them that you can implement it, then I think you have a fair chance. But you can only do it if you really show the full spectrum of optionality on the table. And I think, unfortunately, most of the investment committees I have seen, and I'm very close with the banks, they all say, Michael, we never see these spectrums of optionality. And we go half blinded to our investment committees. And they, of course, say, we only see half blinded, so let's go for the more secure route, which might actually be a liquidation in the end.
Your role, though, must be critical to this because, and I mean, you've argued that CROs need operational control, you need liquidity oversight, and you need stakeholder authority. Without those, I think it's very difficult to execute on any kind of plan that you may have or have put on the table. Yet many mandates are still advisory. Would you say a weak mandate is worse than no mandate at all? And is that still critical to a successful turnaround where you have a CRO who's identified a plan, has got value, and then has been given a full mandate to then go in and implement?
Oh, you hit the nail on the head, and I want to talk about two examples that are actually quite important to me. The first example is a few years back, I was CRO at unpack, the leading African packaging
Yeah.
company who was in big trouble, as I guess you know.
After Andre de
And
Ruyter's tenure.
yes. And when I joined the company as a CRO, there was a change in management team. And what happened is, and I think this is actually the best setup if you talk about a CRO involvement, we had a turnaround-minded CEO, Phil Rue. We had a turnaround-minded chairman of the board, Andre van der Veen, and we had a very experienced CRO. And the three of us sat together and say, can we make this happen? Can we pull this off? And we said, yes. Did we always agree on everything? No, certainly not. And we really bounced heads. However, because we all were convinced we can make it, we actually really made it. And I think it was one of the most successful turnarounds. And in that specific instance, I didn't need a lot of authority because I had my authority for my part, but it was always backed up by the CEO and the chairman. Now I'm in a different case where I'm the CRO, where I'm asking as the CRO for a lot of authority because, as you say, I need to be able to influence many, many things. And authority doesn't always need to be that I call the shots. Authority also can be happening via reporting requirements, via transparency. So authority, whether it is naturally in the unpack example, where three people were absolutely aligned, and this gave the authority, or whether it's really codified in the scope for the CRO is absolutely important. Without authority, it's not going to happen.
Just casting my mind back to unpack, I think we saw creditors effectively take control of the outcome, didn't we? With the equity quite heavily diluted. At what point does it stop becoming about saving the company and maybe just start being about reallocating ownership?
This is always a big question, Michael. I think actually what happened, and that's the reason why unpack is a quite interesting story. You are right, the creditors took over, but because we were so aligned with the chairman and the CEO later on, we actually brought the equity back to the table with a big rights offer. And then I think it was a really good balance between the equity and the debt holders. And now I think it's more back in equity hands, the way I see the numbers. But you will always come to that situation where someone needs to take a lead, and that person also needs to have the authority to lead the restructuring. What I can tell you from my experience across the whole globe, lenders don't want to be in equity. They want to solve the situation and hand the company back, so to say, commercially to the equity holders. So if lenders take control, if we use that phrase, then it's for an interim period.
Yeah, banks, I mean, ultimately, they don't want to be in the business of running other businesses, right? I mean, that's not,
Yes.
they want to be holding senior debt. That's where they play. I mean, if you're an investor then thinking about post-commencement finance in that capital structure context, is it effectively super senior debt with more equity-like risk? And does that explain why sometimes traditional lenders do hesitate?
Yes. So any form of new financing in a restructuring situation, either you have a very hostile, I would say distressed private equity fund who has a different strategy, but it's most a loan to own strategy. They might give financing. But if it's a traditional lender, it will always be super senior. And then you can argue, of course, commercially, is it equity or is it actually debt? Because super senior is above everything. And I think that is, again, I don't think that's the real problem, as long as people understand the nature of super seniority. However, if you look at it, Michael, if you're a lender, there's lenders already in a company. They all have security package. They all have a ranking within the security package.
Yeah.
Now, one or a few lenders want to have super seniority. And the challenge is not that the lenders want to have super seniority, but that the other lenders allow it. That's actually where the problem comes in.
Yeah. Well, and then it becomes a bit of a bun fight, as we know, and
Mm.
things drag out. Just lastly, Michael, I mean, if you're a CEO or you're a board member listening to this right now, what are the 3 things you should be doing now before you need a CRO? And how should you be thinking about diagnosing the problems to ensure that, given we're facing a big shock, let's face it, we don't know whether the ceasefire is going to hold in the Middle East. We're looking at the under recovery at another huge fuel price increase and going from rate cuts potentially to now holds to maybe even hikes. Things are moving very quickly. And so I think the macro environment is going to provide a lot of stress and sleepless nights for boards. What should they be watching like hawks through an environment like this?
My first advice would be, and that is a learning I personally actually took out of the unpack matter, review your risk register in a company. Because if you look at most risk registers of companies, you have something like the margin drops by 1%. There might be, I don't know, global warming. So it's very high level risks, but the real risks are actually lying in things like the war in Iran, but also cybersecurity. And I think you should actually think about your business model as a risk. So that would be my first one. Change in the risk committee your view on the risk to the company. And one risk should be, is our business model sustainable and is it defendable going forward? That's my first advice. My second advice is, that's more South African advice. Boards very much listen, rightly so, to their legal advisors. And I think there's nothing wrong with it. But because the whole legal industry in South Africa is geared towards business rescue, you always get a lot of advice that is very conservative and legalistic driven. And I think boards would be doing very well if, next to the legal advisors, they would really have someone who is a turnaround minded advisor, and another board member maybe that can come onto the board, or maybe an ex-CEO who has done a lot of turnarounds. So what I'm saying is, don't only listen to legal advisors, because as we discussed at the beginning, it's a different mindset. And then, of course, look outside. When I started my career about 30 years ago, when you mentioned in Europe, in the US, the word turnaround restructuring, you were persona non grata. Nowadays, it is very, very simple. It is just a tool. And if I talk to very successful CEOs in companies in Europe and the US, and I tell them that we do restructuring turnarounds, they invite us actually as speaker for company events, just to make sure they hear a different perspective. So be more open-minded. And of course, my last advice is, we have a very strong business culture in South Africa, which I really admire as not being South African. But it also sometimes makes us a little bit stubborn in the way we think and how successful we are. Asking for advice is not a bad thing.
Hubris, yes. It is always one of those things that does come with success, and the ability to park that ego just for a little bit and get an outside view, I think certainly doesn't hurt at all. Well, speaking of outside views, thank you for yours, Michael Dorn, CEO of RTgroup, turnaround specialist, not business rescue specialist, offering a timely and frankly and a necessary reframing of how we think about restructuring in a world where stability is certainly not a given, but a fleeting moment in time. That's it for this episode of the Monocle Banking Podcast, as always curated by Monocle Solutions. If you enjoyed the convo, be sure to subscribe and share it with your network. Until next time, I'm Michael Avery.